The Invisible Man. That is what they called him. Bill Hwang. You never heard his name. Wall Street never saw him coming. He ran a family office called Archegos Capital Management. Not a hedge fund. Family offices do not have to register with the SEC. They operate in shadows. No disclosure requirements. No public reporting. Complete secrecy. By March 2021, Bill Hwang controlled positions worth over $160 billion. $160 billion, with only $10 billion in actual capital. 16-to-1 leverage. Some positions reached 20-to-1. It was a house of cards built on borrowed money. Then it collapsed. Not over months, over days. March 26, 2021. ViacomCBS announces a stock offering. Shares drop 9%. Archegos cannot meet margin calls. Banks panic. They start selling. Friday, March 26th. Blocks of ViacomCBS, Discovery, Baidu, Tencent Music flood the market. Billions of dollars. No explanation. Monday, March 29th. More selling. Goldman Sachs dumps $10.5 billion in a single morning. Morgan Stanley sells nearly $7 billion. By Wednesday, March 31st, it is over. Bill Hwang lost $36 billion. The biggest personal wealth destruction in history. Banks lost $10 billion. Credit Suisse alone lost $5.5 billion. Nomura lost $3 billion. The Invisible Man became visible because he destroyed everything. Bill Sung-Kook Hwang was born in South Korea in 1964. His family immigrated to America when he was young. They settled in New Jersey. Hwang attended the University of California, Los Angeles. He graduated with a degree in economics. Then he earned his MBA from Carnegie Mellon University's Tepper School of Business. In 1996, Bill Hwang joined Tiger Management, the legendary hedge fund run by Julian Robertson. Robertson was one of the greatest investors in history. He launched dozens of protégés. They became known as Tiger Cubs. Hwang was one of them. He focused on Asian markets, particularly Chinese stocks. He was brilliant, aggressive, relentless. By 2001, Julian Robertson saw enormous potential in Hwang. He gave him seed capital to start his own fund. Tiger Asia Management was born. Hwang set up operations in Hong Kong and New York. For a decade, Tiger Asia thrived. Hwang made billions betting on Chinese technology and consumer stocks. He had exceptional timing. He understood Asian markets better than most Western investors. Banks loved him. He generated massive trading commissions. Prime brokerage relationships flourished. Credit Suisse, Morgan Stanley, Goldman Sachs, Deutsche Bank, Nomura. They all fought for his business. By 2010, Tiger Asia managed approximately $5 billion. Bill Hwang was living the dream. Wealthy, respected, connected. But beneath the surface, something darker was building. In 2012, everything changed. Hong Kong Securities and Futures Commission charged Tiger Asia Management with insider trading. The allegations were serious. In 2008 and 2009, Tiger Asia had traded shares of Bank of China and China Construction Bank ahead of major stock offerings. Someone at Tiger Asia received confidential information about the timing and pricing of those offerings. They used that information to profit. The trades made millions. In December 2012, Bill Hwang pleaded guilty. Tiger Asia paid $44 million in fines and disgorgement. Hwang was banned from trading in Hong Kong for 4 years. But the problems did not stop there. In 2013, the United States Securities and Exchange Commission filed charges. Wire fraud. The SEC alleged that Tiger Asia manipulated Chinese bank stocks. They would take large positions, then manipulate prices through carefully timed trades. Profit. Repeat. In January 2014, Hwang settled with the SEC without admitting or denying guilt. Tiger Asia paid another $60 million. Total penalties exceeded $100 million. Bill Hwang was now a convicted felon in Hong Kong, banned from one of Asia's most important financial centers, settling with the SEC in America. Any normal fund manager would be finished, career over, reputation destroyed. But Bill Hwang was not normal. He saw an opportunity, a loophole. He would shut down his hedge fund and transform into something regulators could barely touch, a family office. In 2013, Bill Hwang converted Tiger Asia Management into Archegos Capital Management. The name came from a Greek word meaning leader or prince, but more importantly, it meant freedom from regulation. Family offices manage money for a single family. They are exempt from most SEC registration requirements. No Form ADV, no public disclosure of holdings, no reporting of trading positions, complete secrecy. Hwang structured Archegos carefully. It would manage his personal fortune and his family's wealth, not outside investors. This was critical, because family offices operating solely for family members face almost zero regulatory oversight. They can trade with enormous leverage, concentrate in a handful of positions, take massive risks, and no one knows. Hwang moved quietly. He maintained his relationships with major banks. Credit Suisse, Morgan Stanley, Goldman Sachs, Deutsche Bank, Nomura, UBS. He told them he was running a family office now. The banks did not care. Hwang was a huge client. He generated hundreds of millions in annual trading commissions, prime brokerage fees, securities lending revenue. Hwang was a profit center. Banks competed to give him more leverage, bigger credit lines, better terms. They wanted his business. Between 2014 and 2020, Archegos grew exponentially. Hwang focused on a concentrated portfolio: media stocks, technology stocks, Chinese ADRs. He used total return swaps, a derivative that gave him economic exposure without actually owning shares. This meant he could avoid disclosure rules. No one knew how big his positions were. The invisible man was building an empire in the shadows. Bill Hwang's strategy relied on a financial instrument called total return swaps. These are derivatives. They work like this. Hwang approaches a bank. He says, "I want exposure to ViacomCBS stock, but I do not want to buy the shares directly." Instead, the bank buys the shares, holds them. Hwang enters a swap agreement. He receives all the economic benefits. If the stock goes up, Hwang profits. If dividends are paid, Hwang gets them, but he never owns the shares. The bank owns them. This has massive implications. First, Hwang avoids disclosure requirements. In America, anyone who owns more than 5% of a public company must file a Schedule 13D, disclose their position, explain their intentions. But with swaps, Hwang is not the owner of record. The bank is. No disclosure required. Second, leverage. Banks will lend against swap positions at much higher ratios than traditional stock purchases. Hwang could control $10 or $15 or even $20 of exposure for every dollar of his own capital. Third, concentration. Hwang built enormous positions in a handful of stocks: ViacomCBS, Discovery, Baidu, Tencent, Music, GSX Techedu, Farfetch, VipShop. His exposure to some stocks exceeded 20% of shares outstanding. But because he used swaps with multiple banks, no single institution knew the full picture. Each bank saw only their piece. They assumed others had smaller positions. They were wrong. By early 2021, Archegos controlled over $160 billion in total exposure, with less than $10 billion in actual capital. It was leverage on steroids, and it was invisible. Bill Hwang was not a diversified investor. He was a concentrated gambler. By March 2021, Archegos held massive positions in fewer than a dozen stocks. ViacomCBS was his largest bet. The media conglomerate owned Paramount Pictures, CBS Television Network, Showtime, and the streaming service Paramount Plus. Hwang believed the stock was undervalued. He built a position representing approximately 40% of ViacomCBS's total market capitalization, 40%, through swaps held across multiple banks. No single bank knew how large his total position was. Discovery was another huge bet. The cable television company owned networks like Discovery Channel, HGTV, Food Network, and Animal Planet. Hwang owned exposure to roughly 30% of Discovery's market cap. Again, spread across multiple banks. Nobody saw the full picture. Then there were Chinese stocks: Baidu, the search engine giant; Tencent Music; GSX Techedu, an online education platform; VipShop, an e-commerce company; iQIYI, a streaming service. Hwang loved Chinese technology. He had made billions on these stocks over the years. He believed in their growth. His positions were enormous, and all of it was leveraged. For every dollar Hwang put up, he controlled $15 to $20 of stock exposure. When the stocks went up, his wealth multiplied. In late 2020, his bets paid off spectacularly. ViacomCBS rose from $11 in March 2020 to over $100 by March 2021. Discovery doubled. Chinese tech stocks soared. On paper, Bill Hwang was worth over $30 billion. But it was a house of cards, and the cards were starting to wobble. March 22, 2021. Monday morning, ViacomCBS announces a $3 billion stock offering. The company plans to issue new shares to raise capital. This is common for growing companies. They sell shares to fund acquisitions, pay down debt, or invest in streaming content. The announcement should be routine, But for Bill Hwang, it is catastrophic. Issuing $3 billion in new shares will dilute existing shareholders. More shares outstanding means each share is worth less. The stock opens Monday morning. Immediate selling pressure. ViacomCBS drops 9% in a single day, from $100 to $91. 9% may not sound devastating, but for Archegos it is an extinction-level event. Remember, Hwang is leveraged 15 to 1, some positions 20 to 1. When a stock drops 9% and you are leveraged 20 to 1, your equity drops 180%. You are not just wiped out. You owe money. Margin calls arrive immediately. Credit Suisse calls. Morgan Stanley calls. Deutsche Bank calls. Nomura calls. They all want more collateral. Now, Hwang scrambles. He tries to post additional margin, but his entire portfolio is collapsing. ViacomCBS is his biggest position. Discovery starts falling too. Sympathy selling. Investors worry if ViacomCBS is diluting, maybe Discovery will too. Chinese tech stocks are already under pressure from regulatory crackdowns in Beijing. Everything Hwang owns is dropping. By Friday, March 26th, ViacomCBS has fallen to $77, down 23% in 4 days. Hwang cannot meet the margin calls. He defaults. The invisible man is about to become very visible. Friday, March 26, 2021. After market close, 4 p.m. Eastern Time. Prime brokerage desks across Wall Street light up. Credit Suisse, Morgan Stanley, Goldman Sachs, Deutsche Bank, Nomura, UBS, all holding massive positions for Archegos Capital, and Bill Hwang has defaulted. He cannot meet margin calls. The banks must act. Under prime brokerage agreements, when a client defaults, the bank has the right to liquidate collateral. Sell the positions, recover their loans. But there is a problem. The positions are enormous. Billions and billions of dollars. ViacomCBS, Discovery, Baidu, Tencent Music. If they dump everything on Monday morning, the stocks will crash. Everyone will lose. The banks start calling each other. Emergency meetings convene. Credit Suisse executives gather in Zurich and New York. Morgan Stanley leadership assembles. Goldman Sachs convenes its risk committee. They all face the same question. Do we sell immediately, or do we coordinate with other banks to minimize damage? Some banks want to cooperate. Sell slowly, protect the value of the positions. Maybe Archegos can raise capital, recover, save everyone. Other banks want out. Now, particularly Goldman Sachs and Morgan Stanley. They have been burned before. They remember the 2008 financial crisis, when Lehman Brothers failed, when Bear Stearns collapsed. The lesson is simple. He who sells first loses least. Sunday, March 28th, banks hold conference calls. Heated discussions. Credit Suisse argues for patience. Goldman Sachs says no way. We are selling Monday morning. The decision is made. Every bank for itself. Monday, March 29th, 2021. 9:30 a.m. New York Stock Exchange opens. Goldman Sachs immediately starts selling. Block trades. Massive chunks of ViacomCBS, Discovery, Baidu, Tencent Music, VIP Shop, IQIYI, Farfetch. The trades are so large they have to be negotiated privately with institutional buyers. 10 million shares of ViacomCBS, 15 million shares of Discovery, 20 million shares of Baidu. The prices are brutal. Goldman is dumping at whatever price buyers will pay. The goal is not to maximize value. The goal is to get out fast. By midday, Goldman Sachs has sold over $10.5 billion in positions. They are out, almost completely. Morgan Stanley follows. They start selling Monday afternoon, another $7 billion. Block trades continue into Tuesday. By Tuesday night, Morgan Stanley has exited most positions. Both banks lose money, but manageable amounts. Goldman loses approximately $1 billion. Morgan Stanley loses roughly $1 billion. Not great, but survivable. Credit Suisse makes a different choice. They hesitate. Their risk managers believe Archegos might recover. Maybe Hwang can raise emergency capital. Maybe the stocks will bounce back. They decide to wait, see what happens, give it a few days. Nomura makes the same decision. They wait. Deutsche Bank waits. UBS waits. By Wednesday, March 31st, ViacomCBS has collapsed to $48, down 52% from its peak 2 weeks earlier. Discovery is down 40%. Chinese stocks are devastated. The banks that waited are slaughtered. Credit Suisse loses $5.5 billion. Nomura loses $3 billion. Deutsche Bank loses $1 billion. UBS loses $700 million. The invisible man destroyed them all. Credit Suisse was Archegos' biggest prime broker. For years, they gave Bill Hwang enormous leverage, massive credit lines, favorable terms. Hwang generated hundreds of millions in annual revenue for Credit Suisse, prime brokerage fees, securities lending, derivatives trading. He was a top-tier client. When Archegos defaulted on Friday, March 26th, Credit Suisse held billions in swap positions, more than any other bank. Their exposure was concentrated in ViacomCBS and Discovery, two stocks that were collapsing. Over the weekend, Credit Suisse executives debated what to do. Some risk managers wanted to sell immediately. Monday morning, get out like Goldman Sachs. But senior leadership hesitated. They believed the positions were salvageable. Selling everything would lock in billions in losses. If they waited, maybe the stocks would recover. Maybe Hwang could raise capital. Maybe other investors would step in. They decided to wait. It was the worst decision in Credit Suisse's history. By Wednesday, March 31st, the positions were worthless. Credit Suisse announced a $4.7 billion loss, later revised to $5.5 billion, the largest quarterly loss in the bank's 165-year history. The scandal destroyed Credit Suisse's reputation. Their stock price crashed. CEO Thomas Gottstein faced intense criticism. The head of investment banking resigned. The chief risk officer resigned. Switzerland's financial regulator FINMA launched an investigation. Credit Suisse had to raise capital. They announced a 6 billion franc offering to repair their balance sheet. Shareholders were furious. How did risk management fail so catastrophically? Why did Credit Suisse give one client such enormous leverage? Nobody had answers. The invisible man had taken down a Swiss banking giant. Nomura Holdings was Japan's largest investment bank. Conservative, risk-averse, or so everyone thought. Nomura's relationship with Archegos began in 2014. After Hwang converted Tiger Asia into a family office, Nomura saw opportunity. They wanted to grow their American prime brokerage business. Compete with Goldman Sachs and Morgan Stanley. Bill Hwang was the perfect client. He traded aggressively, generated massive commissions, and he needed leverage. Lots of it. Nomura gave it to him. By March 2021, Nomura held approximately $3 billion in exposure to Archegos, concentrated in ViacomCBS, Discovery, and Chinese tech stocks. When Archegos defaulted on March 26th, Nomura faced the same decision as Credit Suisse. Sell immediately, or wait. Nomura waited. Japanese banking culture values relationships. Loyalty. They believed Bill Hwang would find a solution. They were wrong. By March 31st, Nomura announced a $2 billion loss, later revised to $2.9 billion. The announcement shocked Japan. Nomura's stock crashed 26% in 2 days, the biggest drop since the 2008 financial crisis. Analysts downgraded the bank. Investors fled. Nomura's CEO Kentaro Okuda apologized publicly. The head of wholesale banking resigned. The chief risk officer resigned. Japan's financial services agency launched an investigation. How did a conservative Japanese bank lose $3 billion on a single client? Nomura had to slash its dividend, cut bonuses. Layoffs followed. The Archegos disaster destroyed years of Newly to rebuild Nomura's reputation after the 2008 crisis. The invisible man had reached across the Pacific and devastated Tokyo. How did this happen? How did one man, a convicted insider trader, build a $160 billion empire with almost no regulatory oversight? The answer is simple. Family offices operate in a regulatory black hole. In America, investment advisors managing over $100 million must register with the SEC. They file Form ADV, disclose their clients, report their assets under management, submit to examinations, face strict rules. But family offices are exempt. If you manage money only for family members, you do not have to register. No disclosure, no reporting, no examinations. Congress created this exemption decades ago. The logic was simple. If someone is managing only their own family's money, they are not a systemic risk. They cannot defraud outside investors. Leave them alone. But that logic breaks down when family offices use extreme leverage. Bill Hwang controlled $160 billion in positions, with $10 billion in capital. The rest was borrowed from banks. When Archegos collapsed, it created a systemic event. Banks lost $10 billion. Stock prices crashed. Retail investors holding ViacomCBS and Discovery lost billions, all caused by one family office, operating in complete secrecy. After the Archegos collapse, regulators scrambled. The SEC opened an investigation. The Federal Reserve examined bank risk management. The Bank for International Settlements published reports. Everyone asked the same questions. Why did banks give Hwang such enormous leverage? Why didn't banks coordinate to understand his total exposure? Why didn't anyone see this coming? But the biggest question remained unanswered. Should family offices be regulated? The debate continues today. Archegos proved that unregulated actors with massive leverage can destroy markets. But changing the law requires Congress, and Congress moves slowly. The invisible man exploited a loophole, and no one stopped him. Bill Hwang lost everything, $36 billion. The largest personal wealth destruction in history. By April 2021, Archegos Capital Management was gone, liquidated. Hwang's fortune evaporated. But the legal consequences were just beginning. In April 2022, the United States Attorney for the Southern District of New York filed criminal charges. Bill Hwang was indicted on 11 counts: racketeering conspiracy, securities fraud, wire fraud, market manipulation. The indictment was devastating. Prosecutors alleged Hwang ran a criminal enterprise. He lied to banks about his positions, manipulated stock prices through coordinated buying, used leverage to artificially inflate values, then dumped shares on unsuspecting retail investors. His former CFO, Patrick Halligan, was also indicted. 8 counts. Prosecutors claimed Halligan helped Hwang deceive banks, prepare false financial statements, hide the true extent of Archegos' leverage. Both men pleaded not guilty. Hwang's lawyers argued he was a sophisticated investor who made a bad bet. Not a criminal. The banks knew the risks. They chose to lend him money. If they lost, that is capitalism. But prosecutors disagreed. They had evidence, emails, recorded phone calls, trading records, testimony from cooperating witnesses at the banks. The trial was set for May 2023, then delayed again. As of late 2024, Bill Hwang's criminal trial is still pending. He faces decades in prison if convicted. Meanwhile, civil lawsuits piled up. Credit Suisse sued Hwang for fraudulent misrepresentation. Nomura sued. Shareholders of ViacomCBS and Discovery filed class actions. Everyone wanted their money back. But there was nothing left. Archegos was bankrupt. Hwang's personal assets were seized. The invisible man was now infamous and broke. Today, the Archegos collapse stands as a warning, a reminder that leverage and secrecy are a toxic combination. Bill Hwang controlled $160 billion in the shadows. No one knew. Not regulators. Not even the banks lending him money. When it collapsed, the damage rippled across the financial system. Banks lost $10 billion. Credit Suisse suffered a wound it never recovered from. The bank faced scandal after scandal following Archegos. In March 2023, Credit Suisse collapsed entirely. UBS acquired them in an emergency rescue orchestrated by Swiss regulators. 167 years of history, gone. Archegos was not the only reason, but it was a major factor. The loss destroyed confidence, shattered management credibility, proved their risk management was broken. Nomura spent years rebuilding. Their stock price remains depressed. Their reputation damaged. Deutsche Bank and UBS survived, but barely. The collapse exposed a fundamental flaw in modern finance. Family offices operate with almost no oversight. They can use unlimited leverage, concentrate in a handful of stocks, and nobody knows until it explodes. After Archegos, regulators called for reform. The SEC proposed new rules requiring family offices to report certain information. Congress held hearings, but real change remains elusive. The family office lobby is powerful. Billionaires do not want transparency. Banks do not want to lose lucrative clients. So the system remains largely unchanged. Today, hundreds of family offices operate in America, managing trillions of dollars. Many use leverage, derivatives, complex structures, and we have no idea what they own. The next Archegos could be building right now, in secret, invisible, until it is too late. Bill Hwang proved that one man, with enough leverage and enough secrecy, can shake the entire financial system. The invisible man became visible only after he destroyed everything.